Imagine being responsible for investing $10 billion, not 10,000, not 1 million, 10 billion. This is the weight of institutional responsibility. In a world of social media noise and 24-hour hype, would you buy a stock because someone recommended it online? Would you risk 10 billion because of a YouTube video? Of course not. When institutions invest billions, they don't gamble. Every decision follows a rigorous, structured, and repeatable process. Research, deep analysis, rigorous risk management, independent thinking. These aren't just words, they are the pillars of the institutional framework. Their goal is not finding the next exciting stock or the latest trend. Their primary objective is protecting capital while generating consistent long-term returns. Today you'll learn how institutional investors actually think. Not the myths you hear in the headlines, but the real process. Let's begin our journey into the mind of the institutional professional. Part 1. Who are institutional investors? Simply put, they are organizations that invest massive amounts of money on behalf of other people. They are the giants that move the markets. This includes pension funds managing our retirement, insurance companies protecting our future, and mutual funds that aggregate the wealth of millions. It also covers university endowments, national sovereign wealth funds, family offices, and the aggressive hedge funds you see in the news. Unlike retail investors, institutions manage money with clinical precision. Every decision must be justified. Every risk must be measured against the reward. Every investment must fit into a larger, coherent strategy. This discipline is what fundamentally separates the professionals from the speculators. Part 2. The first question they ask. Retail investors often jump straight to, what stock should I buy? Professionals ask, what environment are we investing in? Before they even look at a company, they study the big picture, economic growth, inflation rates, and the trajectory of interest rates set by central banks. They analyze employment trends, consumer spending patterns, corporate earnings reports, and the health of the credit markets. Context is everything, because no business operates in a vacuum. Understanding the environment provides the necessary context that drastically improves the quality of every decision. Professionals rarely begin with individual stocks. They begin with the world. This perspective is what allows them to stay calm when the market gets volatile. Part 3. The Investment Committee. Contrary to popular belief, major institutional decisions are rarely the work of a single star investor. Analysts present months of research. Portfolio managers ask the difficult questions. Risk managers challenge every assumption made. A healthy debate is encouraged. Disagreement is seen as a tool to improve decision quality. This isn't about being right, it's about getting the decision right. It's a system of checks and balances. Professional investing is not about protecting egos, it is about protecting capital. In these rooms, the best idea wins, not the loudest voice. Part 4. The 5 pillars. Before a single dollar is invested, professionals evaluate 5 major areas to ensure the business is worth owning. Pillar 1. Business quality. How does the company actually make money? Is the demand for their product sustainable? Does it solve a real recurring problem? Pillar 2. Financial strength. They look at revenue growth, profit margins, and free cash flow. Numbers tell the true story. Pillar 3. Competitive advantage. Does the company have an economic moat, a strong brand, patents, or low-cost production that keeps competitors at bay? Pillar 4. Valuation. Even a great company can be a bad investment if you pay too much. Price is what you pay, value is what you eventually get. Pillar 5. Risk. Professionals identify everything that could go wrong before they ever look at what could go right. Risk management is the priority. This 5-pillar framework ensures that no stone is left unturned. It is the difference between an informed decision and a blind guess. Part 5. Thinking in probabilities. Professionals don't predict the future. They estimate the likelihood of different outcomes. They play the odds. Imagine an investment has a 70% chance of success and a 30% chance of failure. It's not a guarantee, but the odds are in your favor. The goal is to make decisions where the expected outcome is positive over hundreds of independent choices. It's a game of statistics, not ego. Part 6. Why professionals love checklists. One overlooked habit separates the pros from the beginners: the relentless use of checklists. Pilots, surgeons, and institutional investors all use them. They verify every detail: debt, management, valuation, before taking action. No detail is too small. Checklists eliminate emotional errors and ensure consistency. The best investors trust their systems more than their own memories or intuition. Part 7. What you can learn. You may not manage billions, but you can think like someone who does. The principles of serious investing are universal. Instead of asking, "How high can this stock go?" ask, "Is this business financially healthy? And what is its durable competitive advantage?" Ask yourself, "What risks am I ignoring?" The quality of your questions will eventually determine the quality of your investment returns. Part 8. The big lesson. Institutional investing is built on preparation, not prediction. It is built on discipline, research, and repeatable processes. Protecting your capital is the first objective. Growing it is the second, because without protection, you won't have anything left to grow. Secure your base. Now, I have a challenge for you. Choose one publicly traded company. Research how it makes money and identify the 3 biggest risks it faces. Is revenue growing? Is debt manageable? Would a professional seriously consider owning this? Think like an analyst, not a gambler. Write your answers. Today you've learned the framework of the elite. This mindset is the foundation of everything we will build together in this masterclass. Structure over emotion. In our next lesson, we will explore how professional investors read annual reports like detectives, finding the hidden value that others overlook. Subscribe to Wealth Entertainment 21. Turn on notifications. And remember, the market rewards preparation, not prediction. I'll see you in Lesson 2.